today, and I'm sorry that you had to listen to our banter before we got started. Uh, so the intent of today's webinar, okay, is as most of you are on here, are on here know who I am, Pinky Shah with Neo Home Loans, and our intent is to be able to do this for our past clients and people that we've had the pleasure of serving, because my commitment is not just to help people own a home, but it's to become successful homeowners and grow their financial wealth and to help them for the next 30 years. And one of the ways that I get to do that is by bringing you knowledgeable professionals in different areas to help educate you and to give you education. And today I'm honored to bring to you Neel Shah. Most of you know that the hat that I like to think about that he wears the most is my husband and the boy who sat in front of me in high school, and the father of my co-parents to Anya and Jaden. So that's the one. But what's probably more relevant to those of you that are on here is that he is an estate planning and tax attorney. He's a certified financial planner. He's a co-founder of Omni 360 Partners, and he speaks nationally at this point on different topics related to financial planning as well as estate planning. And I personally have been getting some questions and hearing a lot of banter about what is going on and people and the fear that people have given what's been going on in the stock markets and just in the economic market right now, in the economy right now. So that's why we thought this topic would be so relevant for everybody right now, and that's why we're bringing this forward. So thank you, Neel, for being here and for agreeing to do this in the evening for us. Definitely appreciate that.
Thank you for having me.
Yeah. So let's get started. So first, Neel, why don't you just tell us what's going on? Let's just go. Let's just tell us what I'm sure most of the people have some idea and they've watched their stock portfolios, but just give us a real professional opinion on what's going on.
Yeah, what's going on? Cue the music from the 90s. It's a great question. Yeah, I guess loaded question. There's a lot going on. I guess if we kind of stuck to the topic of tariffs and rates and markets as a whole, I guess I'm going to say it's like a 30-day window right now. I kind of will always have this etched to my mind because I was traveling internationally when this happened, and that's when everything sort of like it seemed like the quote unquote bottom fell out and crisis mode happened. But really, over the last 30 days the markets, they've been navigating this mix of headlines. So some of them are expected and some of them not so much expected. But one of the key drivers, it's been this renewed talk of tariffs. So the US and this administration, I'm going to stay away from the political discourse that happens there. We're agnostic for this conversation with respect to like political beliefs and thoughts like that. We're just going to focus on what is and what's facts. But the US has basically announced there's this fresh round of tariffs and they're targeting key imports. And right now it's particularly China in technology and electric vehicles. There was talk about it being much more global, much more wide-ranging. But the announcement of these tariffs, it basically got people concerned about inflationary pressure and global trade tensions. And investors don't like that. And the people who guide investors don't necessarily like that. It rattles them. And so basically these tariffs have become sort of like a weapon and for this administration, and they're using it as negotiating tactics, but it's causing a lot of turmoil because people don't know what's going to happen, and markets generally do not like uncertainty. It's uncertainty that leads to volatility. So it's not that, frankly, when President Trump was running, he already had mentioned stuff about tariffs. There's been conversations about tariffs. I think what really kind of took the world by storm a little bit, and the investment world by storm, is the tariffs just happened to be higher than people thought they were going to be. So that was essentially a big piece of it is, well, wow, this is not what we expected. It's more than we expected. It's more expansive than we expected. And then you flip to that, and then there's on the interest rate side. So what happens with tariffs? It increases prices, right? Well, one of the things that we think about when we think of increasing prices is inflation. Like it costs more to buy eggs and milk and sugar and gas and cars and all that sort of stuff. But on the interest rate front, the Federal Reserve has basically said they've kind of stayed in this, we're going to keep it higher for longer type posture. And while inflation has actually cooled a little bit from last year's highs, all this recent data that came out saying it's actually a little hotter than expected. So all these people who were hoping for rate cuts, and the administration has been sort of barking for rate cuts, but the Fed has basically said, no, we're going to take our time with this. So now the market has sort of priced out the idea. And this is what happens, right? The market gets data, it gets information, the investment world gets information, then it bakes it into the pricing, which you would think kind of stabilizes things, but then all of a sudden new information comes in and new things are tweeted out, and then that sort of like unsettles everybody again. But the market now has basically priced out this idea of what's going to happen with the rates, and it's kind of baked into the pricing. But the stock prices and the yields are starting to respond according to that, but it's putting pressure on fixed income like bonds and stocks. What basically most people's consist of investments consist of. So when we zoom out a little bit and we talk about like the broader markets, we're in a bit of a reset. That's kind of what we're seeing. So we had a pretty strong start to the year. It didn't last very long. Volatility crept in. So all these investors, and remember, the majority of trading that's happened in the stock market, it happens institutionally, but investors as a whole, they're digesting all these mixed corporate earnings and these geopolitical tensions, and the stuff in the Ukraine is still going on, and the stuff in Israel and Gaza. So you got all this macroeconomic uncertainty, but as we're going to talk about tonight, we also got some opportunities, and we'll talk on that. So, in short, it's kind of chaotic. It is chaos, but it's definitely choppy. And listen, we've got strategies for this. It's kind of expected in that it's unexpected. We expect the unexpected with portfolios, but we'll talk a little bit more in detail about that too. But that's sort of like my high level observation if you were going to summarize the last 30 days.
Okay, thank you. And I'll add what I found fascinating and other people have is normally for, mortgage bonds are something that I watch very closely because it impacts mortgage rates. And what we tend to find is that when the stock market goes down, mortgage bonds tend to go up because people will flee from the risky stocks and go to the safety of a bond. This time, what's been interesting is stocks have come down and bonds have come down at the same time. And when bond prices come down, by the way, that's when mortgage rates go up. So we've seen, if you've heard about mortgage rates going up in the past couple of weeks, it's been related, like normally they move in opposite directions. So it's been really fascinating to see that happen. And there's a whole bunch of different hypotheses about why that is. I don't know that we want to speculate here, but I just thought I'd add that in to
This is
help
being
folks.
recorded, so I'm just saying, whatever you say, we'll come back to haunt you here.
So let's go on to then what should we be doing now, right? And Neel, you and I both have been getting questions from people, right? And one of the big questions is, what should I be doing, if anything, about my portfolio to protect my portfolio right now? Maybe that's a
Yeah,
good place to
so
start.
it's a perfect place to start. So, it's tempting right now to say do this, do that, like jump out, jump in, that sort of thing. Or I'm definitely not going to say that. I think it's a great time to be very intentional about your investments. So here's like a broad financial plan for everybody. All right. Think of everything that you own. And if you're doing this on behalf of a loved one, think of everything that your loved one owns, and put it in three buckets. This is how we basically start just about every financial planning conversation. You got three buckets. The first bucket is going to be your emergency money. If everything goes to heck in a handbasket, if everything just falls apart, and you're not able to make any money or draw any money, you have to have some sort of emergency bucket. So that's the first emergency bucket. Maybe it's, if you're working, it might be 6 months of living expenses, it might be 12 months, it might be 18 months. It depends on how comfortable you feel. But that's the kind of money that should not be subject to these sort of market fluctuations, the things that are going up and down. So being intentional means having that first bucket, which is your emergency bucket, but you still have to earn something on that. Because if that emergency bucket is there to make sure you pay for groceries and healthcare, the cost of groceries and healthcare are going up. You still have to make money on it. You can't just stick it under your mattress and say it's done. So that's being intentional. Make sure you have your emergency bucket. The second bucket is going to be your lifetime bucket. If I live off of $10,000 or $20,000 a month, I need to know where that $10,000 to $20,000 a month is coming in. Now, if I'm working, it might come from my salary. If I'm supplementing it with my portfolio or pension, if I'm in retirement, or if I've got rental income coming in, then you supplement it that way. But know that you have that second bucket taken care of. And then the third bucket is stuff that you probably are not going to touch over time. Younger people might say, hey, that's life insurance. I'm never going to touch that. But as you get older in life, you might say, there's some retirement money I'm never going to touch, or I've accumulated more than I'm going to spend. There you can be aggressive because you have a long horizon, because it's not timing the market, it's time in the market, right? So it's a little semantics, but one of the things that I'm hearing over and over again, not from my clients, because we've done a pretty good job of sort of training our clients about this, but is, hey, maybe we just kind of put everything out of the market. Or maybe we just take everything out for a little bit. Let's see how things play out. And when things are done sort of settling, well, okay, if you're going to try to time the market, if you're going to try to time when you get in and when you get out, you got to be right twice. First, when you get out, and second, when you get in. So, one of the things I love to share, and almost every one of my clients have seen this, so I'm just going to apologies to those who have already seen it. But right now, you're looking at this screen. Make sure can you see the S&P 500 right there?
No,
No? Okay. How about now?
it's coming up. There we go.
You can see the S&P 5 index. Make sure I'm showing the right screen.
Yes.
Okay, so what this basically tells us, and if you're listening and not watching, keep chopping the stuff for dinner, and I'll just talk you through this. But let's just say we had $1,000 that we put into the market back in 1990. That $1,000 would basically be worth $27,000 today. Let's just say you missed the one best day in the market. Instead of having a 10.21% rate of return, that 27,000, you have 24,000. Okay, not so bad. But let's just say I missed the five best days. You now are down from 27,000 to 17,000. Missed the best 15 days, the best 2 weeks, you go from 27,000 to $9,412. So one thing you do not want to do is jump in and out. Assuming that you've been intentional about how you're actually investing and assuming you're intentional about having money in there too. So just being disciplined, I think, is probably one of the most important things to keep in mind. Now, there's a whole list of things that we could and should be doing. But I think for our conversation purposes right now, just being mindful of the fact that if you haven't stepped back and sort of identified what is my money doing for me? Is my money working for me? Is it providing the security in case of emergency? Is it meeting my lifestyle? Is it more for long-term future growth? Being very intentional about it and then making sure you're invested appropriately is probably one of the most important things to do right now. There are some other opportunities, which I'm sure we'll talk about, but let me just stop right there. Make
Yeah.
sense? Questions, thoughts?
No, that makes a lot of sense. And it makes me, think about and wonder too, and we've gotten this question too, like, how do we think this is all going to impact long-term goals too, right? Because with all this volatility, and I
Well, can
think
I
I know the answer based on what you just said, but let's just put it out there.
Well, so let me put this out there because whether it's somebody who's younger in life, and I think this relates to a question that came in here from our friend Madhu, so thank you for that. But whether this is somebody who's younger in life and is looking to actually buy a home right now, or whether it's somebody who's later in life and is basically considering either selling a home and then buying a home in a 55 plus community, or somebody who's saying, well, I don't want to invest in the market if it's like this. I'd rather invest in real estate. How do you take what I just said there and relate it back to housing as a whole? Should I just stop investing in the market? Should I just buy gold? Should I just buy real estate? And how would you address the real estate question specifically right now?
Yeah, so I can definitely address that. And I think what might be relevant if I just share my screen here for a second with you. I pulled up a chart to help answer my friend Madhav's question here. Let's see. So I'm going to share my screen in a quick second. Getting there, you guys. Okay. So what I think is relevant to that question is what happens with home price appreciation, right? Tell me if you can see this. It says annual appreciation for the past 83 years.
Did you mean to share my baby pictures? No, I'm
Don't do
kidding.
that to me.
Yeah, it's right. Yeah.
Okay, so you should see something that says annual appreciation for the past 83 years. Let me tell you what this shows you. It's home price appreciations from 1942 to 2024. So in the past 83 years, 75 of those years have been positive appreciation. Only in that period, right, where we had the housing crash, which, as you know, or if you don't know, if you were too young at that time, that happened because of crazy rules where we would say, do you have a pulse? Okay, great, you can get a mortgage. That's all the validation that was necessary. It's okay if you're out of work. It's okay. We can work around that. That was a good reason why that happened. So not indicative of what typically happens. And so you can see that typically home prices do appreciate. So with the question of, is this a good time to buy a home or not? My answer to that question is, well, if we don't buy a house today, we're missing out on appreciation, right? And here, let me show you this too. This shows, there's a lot of talk about a recession, right? Some people say we're in a recession right now, but I learned that they changed the rules of what they're calling a recession recently. So maybe we're technically not in it. Either way, we're in a recessionary type period. And so these shaded bars, they show recessions. And this home graph, this line is home values. And so home values have increased except for the one that we just talked about. Every other time besides that, home prices have increased during that time period. So it's likely that there's no reason to suspect that because of the current situation that home prices should drop. The
So
other
that
question,
where
oh,
you
go ahead.
just sorry, just a really quick question about that last one. Like with that point where it did drop, it wasn't like a serendipitous. Like stock market drops are much more crazy than that too. So what are we looking at numerically? Like it looks like it's like
Well, here, we
200.
have it right here.
Okay, perfect. And
Yeah,
just
right
if
here.
anybody doesn't know, that's when Pinky and I bought our house in 2005. So it kind of gives you
I
an idea.
loved it. And not only did we buy in 2005, you guys, right here, 2005, 14% appreciation. We bought it on December 31st of
Mm,
2005. So that appreciation happened and we owned it through all of this.
yeah.
So, and listen, we still happen to be in our home. So yes, it lost appreciation. If we wanted to sell it in 2012, it would have been really bad. But otherwise it
Didn't.
wasn't.
And it's 2024, and now we basically got the benefit of all that growth over that time.
All
So
that growth, which well makes up for these losses here, right? And again, this is so only if you happen to have bought right around here, right? Any other time in history, if you bought your odds, you're betting, you have a winning chance here is what this shows. And then the next question is what happens to mortgage rates, right? Again, these shaded gray bars are the recessions, and this red line is mortgage rates. And so you'll see that historically, after a recession, rates tend to come down also, okay? So rates tend to come down. And so your question could be, should I wait for the rates to come down then? My answer to that question then goes back to what happens if rates go down, one, to the amount of people that are buying a home, increase or decrease? What would you say, Neil?
if I'm gonna guess at some, you're asking me if the rates are going to increase or decrease right
No,
now?
no, I'm saying that when the rates decrease, what do you think will happen to the number of buyers that
Oh,
enter them?
it floods in. We went through this already. Yeah, this is
And then if it floods in, what happens to home prices?
they go up.
They go up even more, and they're already expected to go up, right? Based on all of this, but they could go up the way that they did right here. If we go back to 2020, right? What happened
Mhm.
when that happened? Home prices increased massively. So the question is, do you want to get in ahead of that or behind that? Is
Is the analysis different? I have a thought on this too, but is the analysis different if we're talking about an investment property versus a primary residence?
a little bit different because you have to do the math, right? So investment property is a primary residence. If you have a need for it, for whatever your need may be, more space, different location, whatever your driving causes, it maybe you rent right now and you want to buy, right? So those needs are going to be different than investment. For investment, you have to really look at dollars, right? Are you buying it because you're looking for cash flow? Or are you looking for equity growth or maybe both?
Right.
And so we have to do that analysis, and it would depend. And we have investment tools that we can use to help people figure that out. But I think that the analysis is different depending on what you're buying it for.
Got it. Well, I guess just to stick along those lines too, I see there's another question that came in. If you
Yeah,
could, maybe you want to pop, but
go
has
ahead.
there been a situation in the past in your chart where the real estate market has popped, like the bubble burst? Like, would you describe what happened in 2007, 2008, 2009 as a bubble burst itself? Because at that point, I can tell you what the market did. And I do believe at some point the market may do this again, is the market, quote unquote, pops. And that seems like it's a good entry point. Now, you only know it's a pop in hindsight. It could just be a temporary blip. So that is one of the
Yeah.
things I think from a timing perspective, which is also sort of fine. But yeah, I mean, is there an idea that the market's going to pop?
No, the idea is not that the market will pop because this is very different, right? So this is a very different time than when we had that pop, right? And the pop would have been what we will call that event back, with those 5 declines in a row. Remember, out of 83 years, it only happened in that one period of time. So if we're looking at history as an indicator, you kind of have another 70 years before you can expect that to happen again. So unless you plan to wait 70 years, you don't know how long you're going to be waiting for that pop, number one. And
Yeah,
number two, if we say, I say that partly facetiously, but the other main thing that I'm going to say that is we're in a very different time than when that pop happened. As I talked about, there was very lax rules that happened back then with the mortgage lending. So therefore, there was a lot of foreclosures and stuff like that that happened. If we look at jobs markets then and now, they're very different. Unemployment rate then and now, it's very different. If we look at housing starts, the number of inventory, the amount of inventory, that was very different than it is right now. And I have a chart that I know that's not what our, I can send that to you if you guys want later. So I'll shoot that out in our recap because I didn't have it teed up, but I will send that over and you can see the differences between the then and now and why we wouldn't call this a housing bubble right now. This is
Yeah.
true appreciation.
Well, let me kind of use the real estate bit a little bit and talk about, can you see my Skittles chart here?
Mhm.
So this goes back to like the market and real estate as a whole. What you're looking at here is not meant to give you sort of a seizure or anything like that. All these colors are a little trippy. I get it too. But if you look at the different asset sectors, like all these colors here represent different types of investments. So the light blue, the teal one here is S&P 500, US large value stocks. This really magenta-ish, purplish one is real estate. So this story tells you that basically over the last 20 years, these are the best performing sectors, the highest performing sectors of types of investments over the 20-year window. Do you see a pattern here?
No, it
Good,
looks
because there is
like
none. Yeah, that was a trick question. There is no
cute. I
pattern here.
know.
So the
Yeah.
reality is there's not going to be a sector that consistently performs well. What you're looking at here in the white boxes right here, that's what a 60/40 portfolio is. We talked about stocks and bonds. It was generally been the rule for like what a diversified portfolio looks like. That's essentially that middle of the line type of investment. So when people say, you know what, I'm just going to invest in real estate. Well, yeah, okay, real estate has some good performing years. There are some really bad performing years too for a real estate perspective. And this is more on a global scale. It's not just so we can dive deeper into each one of these too. My point is if you're investing in the real estate at all, A, it doesn't have to be owning actual real estate. It could be things like real estate trusts, it could be REITs, it could be a property, a stock or a bond that basically is tied into some sort of real estate ancillary type investment as well too. But it's just all the more reason for making sure that you're sort of spread out across the table because you don't know which sector is going to be doing well at any given point.
Yeah, makes sense. Absolutely makes sense. And there's one more
Thanks for
thing.
that question, Devika. That was great.
Yeah, it was a good question. And I want to just add one more thing actually on that question. Let me see if I'm going to share this slide also. Whoops, this is not the one, but I'm going to go back to it. Oops. Oh, here, this is the one I wanted to share. Do you see this? This is a chart that shows, Neil, this kind of addresses your question about, is it different if we're talking about for primary residence or investment property, right? And if you currently own or rent, the answer is super important too, because this shows the net worth of homeowners versus renters. So as a homeowner, your net worth significantly increases. So if you don't currently own, it's an amazing opportunity to just increase your net worth, irrespective of the economy, as long as your personal finances allow for it. That's what I focus on. So just thought I'd bring that into.
Yeah. So
All right.
since we're
Yeah.
competing right now and talking about and screen sharing here, so I'm gonna basically take over the screen, send a
Yeah.
request to the screen
Knocking
share
me
as well
off.
too.
Yeah. There you
Um,
go.
so this goes to Jaquita's question about what are we looking at from a market perspective? And the reality, I said this facetiously before, is the market going to go up or is the market going to go down? And the answer is yes. It is going to go up or down. I think the idea here is to use history to your advantage. And I know I'll preach discipline, but this is a tool that I use often with clients as well too, is I want to show them like what if history were to repeat itself? How does the world look? So what you're looking at here is, let me know when you can see my screen.
Yep. We can see it.
Okay. So there's a bunch of different sort of portfolios here. You see these number 40, 73, 80, 89. That represents different portfolios' risk levels. It's a tool that we use. So basically 40 would not be a very risky portfolio. 73 would be more risky. 83 would be even riskier than that. And 89 would be considered very risky and risky from a high level perspective. So you mentioned that financial crisis. Our biggest dip has been that 2007, 2008, 2009 window. When markets really go through this sort of turmoil, you could see how bad things get. Like these portfolios, even a number 40 would be down 18%. So a $1.2 million portfolio would be down 216,000. And you'll see this iShares one, which is considered very volatile, would be down 65%. Like that's enough to make you not like it will cause some mental health issues when you start looking at that on a regular basis, right? And understandably so, because you're seeing your money on paper evaporate. The worst thing people would do at that point is liquidate. The best thing people will do is just cost average in, just put in $100, $100, $100, like have an automatic deducted pay amount coming out of your paycheck. Because, and this is where I think it's fun, is you see that people who stay disciplined and keep investing in there, when you zoom out from this is from October 2007, and I'm going to zoom out here to let's just say even 2015. Say we're not going to touch this money for 8 years, but we're going to keep our discipline. Watch what happens to these rates of return. Over that period of time, these portfolios are getting compensated for the level of risk that they're taking. So this is where panicking and locking in losses is probably the single biggest mistake people will make in their financial mistake they will make in their lives. There are still people who are kicking themselves to say, hey, I need something out. Now, what I do think is really important is if you know that you have certain expenses, a kid going to college, buying a house, or you need to replace a roof, or you think somebody might be getting sick or something like that, you can be intentional about cost averaging out. What I mean by that is like, okay, it's going to cost me $100,000 a year to pay for a kid's tuition. Let me take $10,000 out a month of my portfolio if I have a large enough portfolio. Or let me just cost average in. Let me make sure that I cut maybe like $500 out of each paycheck and make sure it's going into the market so I can take advantage of these upswings on the opposite side itself too. But just a cue here, like even when we had something as recently as the pandemic in 2020, we had a period of super volatility before vaccines and all that stuff came out. Well, okay, that was pretty painful. People were sitting at home. There was a lot of time to refresh your browser and see how the market's moving. Well, if you lock in those losses, you're done. But I did speak with some folks, and I can see by the names on the roster, there's a couple people on these calls that I might have spoken with as well too. If we held the fort and we basically said, look, we're not going to sell, we're going to stay disciplined on this, even through April 2015, check out what happens to the rate of return in that period of time. That's a 5 year window. So just be wary of that. That's the biggest mistake that people will take. And and then we can talk about the opportunities as well too. But any
Yeah.
thoughts, questions on that?
Neil, at some point you've shared with me a chart that kind of shows the different um, economic events and world events and the impact of that.
Yeah.
I think also to answer Jaquita's question kind of about economic and market predictions, right? Like I feel like that chart might be helpful.
Yeah. So one of the questions that we get most often, or the comments I get is, "Hey Neil, nothing like this has ever happened. Like this is unprecedented." And I get it. It is. But it is precedented in that it's unprecedented. So what do I mean by that? I think this is the one you're referring to, Pink.
Yes.
Yeah. So this basically, and it's hard to read, but if you look at it, it's telling you about different world events that happened over time, and it's telling us what the growth of that dollar was during the world events. So what are we talking about here? We're talking about the Y2K scare. Some people might actually be too young to remember Y2K, but we thought the world was going to end at December 31st, 1999 before we crossed over because the computers weren't ready. And then there was the 9/11 attacks. Then there was that prime mortgage index. And then we thought there was going to be this virus that was going to knock out all of the world. So there was all these things, Iraq invading Kuwait, and you got everything back here to like the death of equities, and oil prices were quadrupling. There were gas lines, and all that other stuff was going on. All these times we thought the world was going to be done. It's all of these were also unprecedented. But you see that we just sort of kept humming along. And this has been going on since 1970. The world seems to adapt. The world continues to grow. And if you looked at different sort of, I can go all day over basically, this is since 1926, like what's happened with these small cap and large cap investments itself too. The world adapts to world events. And the market, really, really important distinction for us to remember. When it comes to people think of the economy and the market as synonymous. They think of it as the same thing, but they're not. When you hear about how many jobs there are and what unemployment is and inflation is, and we talk about the price of things and who's getting contracts, who's not getting contracts, that's the economy. That's what's actually happening. There are indicators for this. That's the economy. The market and your investments is really more speculative. It's what people think is going to happen in the future. That's why they don't like certain uncertainty. So the market is all about what do we feel about the world itself. And when we had these crazy tariffs and it's like, well, everything's going to become 5 times as expensive. Now we're worried about the future. The market does not like that. But then what happens in a couple of days is people sort of realize, hey, okay, we baked it into the pricing already. Let's go back to ho hum and building that sort of thing too. So the reason we are seeing volatility right now is the uncertainty. In 2007, 2008, 2009, all that volatility was in part because you saw Lehman Brothers and these crazy companies just going under. That's going to cause uncertainty. So you have to distinguish in your mind what the market is versus the economy. And I'll stop on this one too. Remember this. Who does CNBC, Forbes magazine, Kiplinger's, who do they owe a duty to? Do they owe you a duty?
No,
No. They owe a duty to their shareholders. How do they fulfill their duty to their shareholders?
bringing in more ad revenue.
Bingo. If you click, if you watch, if you click on their ads, and if read their clickbait. If they said, I'll give you the example. Like you watch the news at you're watching TV at 5 o'clock, and they say news at 6 o'clock, everything's fine. See you at 6. Are you gonna log in? No.
Mhm.
But if they say, snow, what was it? Snow cyclone bomb coming in, and you buy your milk and your eggs, and everything's gonna go haywire. More at 6 o'clock. Or there might be a flesh-eating bacteria in your fridge. More at 6 o'clock. You're gonna log in on that. So
Mhm.
they are incentivized to fearmonger and to actually get you to click. They are not there to educate you. They're not there to teach you. They don't owe you a duty. They owe their shareholders a duty, and they're only fulfilling that duty if they are a little sensationalistic about this, if they're a little bit more cataclysmic about this too. So, when in doubt, tune out. It's
Yeah. Well, and I think that's a good point. And the question would be then, how do you educate yourself, right? And I think that's a good opportunity. Neil does bi-weekly, is it right? Market updates and newsletters that have useful information. So if any of you want to get unbiased and, not sensational news, but actual news about what's going on in the market, you can message us after this if you want, and just let us know that you'd like to be added to his newsletter. And then I do the same for the housing market and mortgage rates. Okay. So if you are not on either of them and want to be on either, feel free to message us and we'll be happy to add you so that you can get information if you feel like we're trustworthy, then from people that you trust, right?
Oh,
Yeah.
another PSA, really quickly. Maybe this is not the right time to do it, but for anybody who happens to be in the Plainsboro area tomorrow, and since you're on this call, we're actually going to have a food truck in our office parking lot, and we're also going to have a shredding truck. We're celebrating Earth Day, the end of tax season, our amazing tax team. We are celebrating Take Your Child to Work Day, even though my kids aren't coming, unfortunately.
Mhm.
But if you're in Plainsboro area, drop us a note or drop me a note. We'll send you the details on it. We're gonna have a crepe truck there, sweet and savory crepes itself. So I've been starving myself
Yummy.
pretty much since yesterday. So I'll be ready to eat some crepes. But just a PSA,
Yeah.
and then we can talk markets and all this other stuff too. And I think Pinky, you
Yeah.
have your positivity and pastries coming up as well too, don't you?
Yes, yes, yes. We have our positivity and pastries, which is on the third Thursday of the month. So that would make it the 15th. So if any, it's usually real estate professionals and real estate related professionals, but anyone's welcome. But we tend to talk about things like this to help everyone be sharper for their clients, basically. So yeah.
Sharper and fatter because we're all about the carbs here. We got crepes and we got pastries, but there's positivity in markets there too. So we get it's a little bit
Positivity there too. I know. No one went for my positivity and parfaits, so I had to go with the pastries.
of
All right, so let's wrap up. Any lasting questions? And Neil, any tax strategies or anything that we should also? I'm just thinking about what I didn't ask you already, right? That's a question we've gotten.
Yeah.
Anything
So,
on that front?
so a couple of things on this. Yes. I couldn't tell you this is the bottom of the market. I couldn't tell you that things are going to rebound tomorrow. What I could tell you is that things are lower now than they were earlier this year. And if I had to buy something, I'd rather buy it on discount than buy it at full price. So I'm not saying that things are going to rebound today, tomorrow. I It's so important for you to know what your investment horizon is going to be. If you know you are saving for the future, and let's just say you are saving for that house, or you're saving for retirement, or you're saving for a kid going to college, or some other financial goal that you have right now, that goal is going to get progressively more expensive. You can't have that money sitting in a checking account, a savings account, and expect it to keep pace with the goal that you want to achieve. So, this being where it is right now, and know what we just showed you about what happens for the last 100 years in the market itself. This is a good time to identify what those goals are and what your time horizon is, and then let your money go to work for you. Now, on the flip side of it, as things have gone down in prices, we have a lot of clients who basically did invest in certain types of investments and they grew really fast. And now they have a hard time diversifying out of it because they're worried about the tax impact of it. Well, this might be an opportunity to do a couple of things, and it's beyond the scope of our conversation right now. But if you had to diversify an investment, this might be a good time to sell something so that when it rebounds in the diversified investment. If you have a lot of money in IRAs, and you're looking at facing retirement, and you're gonna have to start taking required minimum distributions, look into something called a Roth conversion. If you don't know about that, reach out to us or reach out to your advisor. But the Roth conversion is something that we are actively doing for several clients right now, managing your taxes, just not for today, but for the future as well too.
Yeah, super helpful.
Yep.
Perfect.
And then from a mortgage interest rate perspective, anything specific that you'd want to close up on there?
I mean, I think to answer some of the questions that were asked here, and what I get asked about is really, is this the right time to buy or not? And I said it before, but it really depends on your personal economy. If you can, and your needs, if you have a need to move right now, if you can handle mortgage payments right now, if you have some money for a down payment right now, I wouldn't necessarily, this is again, probably out of the scope of our conversation now, we could talk about it personally, but whether it makes sense to liquidate stocks and whatnot, like we can certainly talk about that. But either way, if you can do those things, the market's gonna do, we're not going to be able to time it, as Neel said, right? We're not going to be able to figure out exactly when we hit the bottom. So you're taking a shot on something that you have zero control over. So focus on what you can control is always my message, right? And what you can control is your personal economy and whether it makes sense or not. And if you can afford the payments, you saw that historically prices do go up and you're going to come out ahead as long as you own the house for more than like 2 years. So
So help help me understand if my logic's right here. Let's just
yeah,
say you closed on a home today at a rate of like 8%. And it's a 30-year mortgage. So one of a couple of things is going to happen over the next 15 years. Either rates are going to go up to 15%, let's just say hypothetically speaking, in which case you're happy you did it at 8% before it got up to 15. Rates are going to stay flat at 8%, in which case you're probably glad that you owned a home for those 5 years. Or the rates go down to 5%, in which case you refinance. But this is the analysis for your consumption, for your home, not necessarily for an investment home itself too. But is there a flaw in my logic there? Like, am I looking at this the right way? That basically it's one of those three scenarios. It's either gonna be flat, up, or down. And either way, you're either thankful, you're gonna refinance, or you're gonna keep things going, but at least you built equity in your home.
absolutely. Yeah. Because otherwise, what's the alternative, right? And that's always what you have to compare is what's the alternative. That was a really good way of looking at it and breaking it down is you don't lose if it goes up. You actually are so grateful that you did it.
Mhm.
If it stays stagnant, you're also grateful because, well, how much longer were you going to wait? And then as long as you keep yourself mortgage ready, meaning you've got a job and you have, good credit history and stuff, you'll be able to take advantage of lower rates when they hit, and you won't be paying the higher prices on homes.
How much of it is regional? Like there are people from different regions on our meeting on our call right here. So how much of it is regional about like okay, like real estate in like the New York City metropolitan area doesn't
Yeah.
really fluctuate quite as
There's
much.
some amount of it, and I can actually drill down to a zip code. So if there's anyone on here that wants to know about their specific market, I can show you appreciation for the past 63 years in your zip code, what the forecasted appreciation is in the past 5 years, what the population is, what the expected number of homes being built are. So we can drill down and do a real estate report card for each independent area and be able to see, is it a good time to buy in your area? There are a couple of pockets across the country where it's starting to become more of a seller's market. But there's benefits to that too, because now you can negotiate. So pros and cons every way. It's just a matter of what's important to you.
So I know you're gonna close this up here, but I'll say, look, if the stuff is changing pretty quickly here, and we're expecting some tax law changes at the end of this year as well too. So yeah, anybody who wants to sign up for our newsletter that's not already on it, and anybody who's on our newsletter will hopefully attest that it is information oriented. It's not spammy, and we try not to do the fear mongering thing. And every once in a while, you'll get a video from me with a little bit of attitude. So hopefully that's fun. But that I do think is my preferred way to kind of stay in touch. But also, you could follow us on social media. We have a Facebook page, a LinkedIn page. We tweet pretty much anything out there except a few. we haven't done Blue Sky yet or anything like that. But yeah, I'd love to connect with anybody who's interested, and we'll try to keep you informed.
Yeah, yeah, I would highly encourage it, not just because I'm married to him, but because I've heard from a lot of people that Neel is absolutely a wealth of information and he shares information. And one of the things that I hear often is that he does it in a way that makes it easy for people to understand. He breaks it down, complex ideas into simplified ways. So if you're not following him, if you're not on his newsletter, I'm sure you'll thank me for it if you are not already on it. So definitely do that. And again, if you're in Plainsboro tomorrow, come see him, let us know. And then if you're not on my newsletter and you want to be on that one, you can let me know that too.
And I will
Thank you
say,
all.
for giving
Oh,
mutual testimonials, Pinky is the most consultative mortgage professional that I've ever spoken with. She takes a lot of her doctorate in pharmacy information and kind of uses that education to expand upon it. So I'm not just saying that because we're going to get off this call and we're going to be in the same living room in a few minutes.
thank you for spending your evening with us. I hope that this has been a good use of your time and that you're happy to have been here with us as we are with you. So thank you, and thank you again, Neel. Have a good night, everybody.
Night all.